Good morning, everybody. There's a lot going on out there, so let's get to it. I'm going to start with a story. When I was a young teenager, I was very competitive. And my father used to say to me, son, everything in moderation, except the pursuit of moderation. That last part always kind of threw me off, but you get the idea. So why bring that up? Well, investors tend to go to extremes. They get over competitive, or we tend to do the same thing over and over again. And once things go to extreme, typically it doesn't work out well. The example I'm going to use today has to do with the stock market and why Walt and I have had some concern. And the term I want you to understand is something called passive investing. So let's go back several decades. Vanguard, it's an amazing fund family, came up with an idea. They said, we're looking around here and we have all these fund managers for mutual funds that have big staffs, that have big salaries. They're constantly buying and selling stocks, and their emotions are as fragile as everybody else's are. Are they really making better decisions? What if we don't pay fund managers? What if we don't have all the analysts? Why don't we just sell the index? If you want to go into the stock market, buy the stock market from the biggest company in America down to number 500, the S&P 500. And let's see how we do. And they did very well. They didn't have to pay the overhead. They didn't have to pay the fees. It was very easy for someone to buy the market and passively say, I don't have to pick stocks. I can just be in the market when I want to be in the market. It was actually a very good idea. And for a long time, the index has outperformed all those managers. And so what happened? The success brought more people over to indexed or passive investing versus active managers. There are very few active managers on Wall Street now. But this is where something good can turn into something bad in the extreme. And I think this is where we are. So, quick explanation. If you have a 401k plan, a 403b, 450, some retirement plan, and every 2 weeks from your paycheck, $500 is going out of your paycheck to the indexed fund, to the stock market, which everybody tells you to do because it's a smart way to do it. I got that. You would think if you put in $500, $1 would go to each of the stocks in the 500. That's not the way it works. It's a weighted average weighting. At the very top, the bigger companies get more money. The Walmarts, the Microsofts, the Googles, they might get $22 of the 500 or 20 or 16 or 14. And down at the bottom, Campbell's Soup might get 25 cents of your $500. That's just the example, but you get the idea. So what's happened is we've had this passive investing grow and grow and grow. And irrespective of how the funds have, or how the stocks have performed, they get the money every payday from millions of people just throwing it in because that's what you're supposed to do. And what it's done is we have this very narrow group of stocks at the top hauling the whole wagon. And the bigger they get, the more money they get. And the more money they get, the bigger they get. And we get this concentration of wealth in a very few companies. And what if a couple of those roll over? Then what happens? And this is the concern that the Federal Reserve has. And you saw it last week when they had the Fed meeting and started talking about lowering interest rates and what are we going to do? The concern about the jobs market, all of this lingo. Why are they so concerned about the jobs market? What if you get a lot of people getting laid off? And that's fewer people putting money into those passive investments. And flows start to reverse because they're not putting money in. They have to take money out. And oh no, we've got a concentration right at the top. You can see where this could go. This is what human beings do. You cannot be with the crowd. The crowd never makes money, ever, ever, ever. And so what you have to do is actually start thinking like they did decades ago and be an active manager, which is what Walt and I are trying to do. Wait, this doesn't make much sense. When money leaves the markets, where will it go? Because wealth isn't necessarily destroyed, or or evaporates, it goes somewhere. What we're seeing now is big money has been moving to the stuff you are in. That's why you have had actually a very nice couple of months here. We believe this trend will still be with us. Does that mean we won't have ups and downs? No. Are we due for a correction? Probably. Are we concerned that the overall trend has been broken? No. So with that, I will turn it over to Walt and hope you enjoy the rest of the week.